Hello, my name is Tim Hamilton, and welcome back to part two of my discussion on student loans and what you need to know in 2021. This presentation is part of my larger Planning on Call blog, podcast, and video series focusing on providing medical professionals and their spouses the important information they need to know as they plan their future. Just to mention again, this presentation on student loans should help anyone with managing their student loans, no matter their profession, but especially those that have large debt levels due to extensive postgraduate education. Before moving on, just a few quick notes on me and my firm, Atlas Private Wealth Management. I'm a Senior Vice President and Wealth Management Advisor here at Atlas, and also a Certified Financial Planner and Certified Student Loan Professional, among other financial designations. I've been working in financial planning for over a decade, and in my current role, I work with over 200 families, helping them plan their financial lives. As for my firm, Atlas, we are a fee-only financial planning firm based in New York, having formed back in 2014. We help individuals with financial planning, investment management, and tax preparation. And very importantly, we are a fiduciary firm and are required to always act in our clients' best interest. Lastly, I would also like to note that all situations discussed in this presentation are for illustrative purposes only. Numbers are estimated, interest rates are assumed, and each specific situation is very fact dependent. So you should reach out to an advisor for help with your personal situation. As a reminder, my student loan overview will be broken up into 3 parts, so feel free to skip around to the section that best applies to you once everything is out. Section 1, which is already out, focused on a broad overview of student loans. Section 2 today will focus on federal student loan forgiveness programs. And Section 3 will present some case studies to show the effects of student loan planning in action. So as I mentioned, today's topic, income-driven repayment plans, or IDR plans, are loan repayment programs for federal loans. Just as a reminder from part 1, this is for federal loans only, so not private loans. Furthermore, if you did have a private loan and consolidated them with a private consolidation firm, that can't be undone. So just as a reminder, this is only for federal loans, and be careful if you ever take a federal loan and consolidate them with a private consolidation firm. But again, these are federal loans, and the repayment program is based on your income, not the amount that you owe. IDR plans are commonly lumped together by individuals, but it's really important to note that they are not all the same. Actually, there are many different types of income-driven repayment plans, and each really are pretty different. So just to go through them each right now quickly, there's the income contingent repayment plan, also known as the ICR plan, the income-based repayment plan, IBR plan, and that is broken up into old and new IBR plans. We'll get into what that means later in this presentation. There's the pay-as-you-earn repayment plan, or payee plan, and revised pay-as-you-earn repayment plan, or the repayee plan. So let's actually start today's discussion with the income contingent repayment plan. I like to start here because this is really what kicked everything off back in 1993 under the Omnibus Budget Reconciliation Act of 1993. And this is a good place to start because everything really did jump off from here. That said, this is the oldest plan and not surprisingly, the least advantageous plan as well. So you don't see much of this in action these days, but again, it's a good basis to really jump off from for the rest of today's presentation. So the way an income contingent repayment plan works is that you will pay monthly payments over 25 years, and then at the end of those 25 years, you will have your loans forgiven by the federal government. A few things to note in terms of how we arrive at the payments and what loans are eligible. First off, any federal loans are eligible. And so that means FEL loans, direct loans, importantly, direct parent plus loans are in this, grad plus loans. So anything can be used in this program. There is no maximum payment amount in terms of what you pay. So this will be completely dependent on your income, even if your income keeps going up and up and up. This does allow for payments. The ICR allows for payments on a single spouse's income. What that means is that you are able to do what's called married filing separately so that you can have this based on just your income, not your joint income with your spouse. We'll get into that in a bit more detail later in the presentation, but note that that is the case with this ICR repayment plan. And also note that interest is capitalizing as the interest grows over time at a rate of 10% of the original balance. And if you leave the plan, the ICR plan, for some reason, your interest is capitalized. And this is really impactful because, as we reviewed in part 1, in a IDR program, there is the ability to have what's called negative amortization, which means that over the life of the 25 years you're making these payments, the loans are actually growing. And so if the loan's then capitalized for some reason, it can, again, be very, very impactful. So these are important things to note as we think about the income contingent repayment plan. In terms of what the actual payments look like, the payments are based upon 20% of your discretionary income. So let's take a second to dive into what that means, 20% of discretionary income. So discretionary income is your adjusted gross income, also called your AGI, which is basically your gross income less certain deductions, the biggest of which being a pre-tax retirement plan contributions. So that's contributions to things like 401ks and 403bs. And again, this is pre-tax contributions, so this wouldn't include Roth contributions. So the discretionary income is your AGI, and then it's minus what's called the federal poverty line deduction. This deduction is based on the number of individuals in your household, as well as the federal poverty line, which is set each year, and it does vary. But for the rest of this presentation, part 3 as well, we're going to use $12,000 for an individual and then $4,000 for each family member. It's also important to note family member includes your spouse and also an unborn child if your spouse or you are pregnant. So what we're looking at, again, is discretionary income being your AGI minus this federal poverty line deduction. So let's use an example here. So let's say a couple is making $100,000 a year. Let's take the whole married filing jointly or separately out of that. We'll look at that later. But let's just say the income is $100,000 and this person is married and they have one child. And between the two of them, they're contributing $20,000 to retirement plans. So this means that discretionary income would start out with the gross income of $100,000 less the pre-tax retirement contribution of $20,000, bringing the AGI down to $80,000, and then minus the federal poverty line deduction, which would be $12,000 for the individual, $4,000 for the spouse, and $4,000 for the child. So that's another $20,000 off, so that the discretionary income is $60,000. So then what we're doing is we're taking that $60,000, multiplying it by 0.2%, 20% of discretionary income. So then you find that the annual loan amount paid is $12,000 per year or $1,000 per month. And again, the size of the loan does not matter. It's purely based on the income. So again, just to note on ICR, last thing I'll say on ICR program is that we don't see this a lot because actually just the way that this is found, it wasn't very advantageous for a lot of individuals. So the next programs that we'll see actually are, again, much more advantageous. But I will say that this is the only plan that allows for Parent Plus loans to be forgiven by the federal government. And so if you do have Parent Plus loans for some reason, this is the plan that you're probably going to have to use if you want to use an IDR plan. So just important to note with this. So now let's move on to the plans that we may see individuals use, I think, a little bit more regularly. And let's start out with the old income-based repayment plan, or more commonly known as the IBR plan. So under this IBR plan, we'll actually learn why this is called old next. But under this income-based repayment plan, you can have either direct or FFEL loans, and not Parent Plus loans though. And you'll see why it's more advantageous now is because the monthly amount that you are paying is 15% of discretionary income. Furthermore, discretionary income is found by taking your AGI and taking 150% of that federal poverty line off. So that's basically you take that federal poverty line that we found in the last piece, and you multiply that by 1.5. So that would mean that the federal poverty line deduction for the individual that we mentioned had a spouse and one child being $20,000. The deduction is actually times 1.5, so it would be $30,000. So let's take this IBR plan using, again, the same individual that I had discussed in the ICR plan. So that would be $100,000 less the of gross income, less the pre-tax retirement contributions of $20,000, bringing it to $80,000, less 1.5 times the federal poverty line deduction. So that would be less $30,000. So now we have discretionary income of $50,000. So if we take discretionary income of $50,000 and multiply it by 15%, not 20%, we see that the annual payments are now $7,500, which is quite a bit less than $12,000 if you look over the 25 years that it takes to have either the IBR or ICR loans repaid. A few other things to note about the IBR program and why it's a little bit more advantageous than ICR. First of all, the monthly payment amount is capped at your 10-year standard repayment amount. So this is really impactful for individuals that may have income that goes up pretty quickly, because if your income just goes up and up and up, you will continue to have to pay more and more and more and more and more. In the IBR, it's capped at what your standard repayment would be. It's also important to note that unpaid interest is subsidized under the IBR program for 3 years. I'm sorry, unpaid interest is subsidized under subsidized loans for 3 years. And this is really important with that negative amortization I had mentioned. And then the last piece is that calculation of repayment must be lower than the standard repayment, which means that you have to have what's called a partial financial hardship. So what this just means is that to get into the IBR plan to begin with, the calculated amount that you have to pay under the IBR plan has to be lower than your standard 10-year repayment. That is an important distinction to make with the IBR program. So another thing to note with this is that FFEL loans are eligible, because you'll see that some of the other ones that we're about to go over is not eligible. So let's move on to the new IBR program. So the new IBR program, the reason it's called the new IBR program is because you can only get into this program if you have loans that start as a new borrower after 7/1/2014. So FFEL loans really aren't eligible because, as we noted in part 1, FFEL loans actually went out of existence after 2010. And this new IBR program is even more advantageous than the old IBR program, because instead of 25 years of payments, you only have to make 20 years of payments. And the monthly amount is based on 10% of discretionary income instead of 15%. And again, you are getting 150% of that federal poverty line deduction in this repayment plan. So if we use the example that we've been using, where it was $12,000 under ICR for a family, then it was $7,500. Under the new income-based repayment plan, their payment would actually only be annually $5,000. So again, considerably less than $7,500 and $12,000 over a 20 or 25 year period. Another thing to know about the old and new, why is it old and new? if you fill out the paperwork to get into one of these IDR programs, you're not going to see something that says old or new. It's really broken up by when your loans are from. So again, if you have any loans from before 7/1/2014, you're just going to be placed in that old IBR program. If not, and everything's after 2014, you'll be put in the new. So you do just have to know the distinction, because that is what your income-based repayment plan will be based off of. So let's move on to some of the other pretty advantageous programs here. The next one I will mention is pay-as-you-earn repayment plan, payee repayment plan. So the odd part about this plan is you actually have to be a new borrower after 10/1/2007, and you also have to have new loans after 10/1/2011. So it's pretty specific in terms of if you're able to take advantage of this program. The other thing I would note is that only direct loans are eligible. Now, I had mentioned that FFEL loans did exist up until 2010. So if you have FFEL loans and you want to get into this payee repayment plan, note that you probably will need to consolidate your loans and therefore have loans go from a FFEL loan into the direct consolidated loan system. So everything is really the same in the payee as the new IBR. So it is pretty advantageous. One thing to note, though, that actually makes this pretty nice, even as compared to the new IBR program, is that there is a cap on the capitalization of the loan balance, and that's at 10%. So payee, if you're able to get into it, is something that is very advantageous. But because of having to be a new borrower after 10/1/2007 and have loans after 10/1/2011, it's just pretty specific in terms of the individuals that can take advantage of this. The other thing I would note about actually both IBR, old and new, and payee is that you can file separately on your taxes and include only your income and not your spouse's. So again, very advantageous. And that is different than the last repayment plan I will mention here, which is the revised pay-as-you-earn repayment plan, or the repayee payment plan. So this, the first thing I'll note on this is that it is the default that individuals will be put in. So just be sure to note that. Just note that default-wise, this is where you're going to be, and you may need to request to get into something else. So just to get into the nitty-gritty of the revised pay-as-you-earn plan, first off, you can have loans that originate from any time, but it has to be direct loans. So FFEL loans, again, make sure you do that direct consolidation at 10% of discretionary income, and you get the 150% of the federal poverty line. So that's pretty good. That's like payee in the new IBR. There are no maximum payment on the loans. So be sure that you note that you are not capped at your standard repayment if your income is growing and growing and growing. Also note that there is no partial financial hardship to get into this program, which means that anyone can get into this program, no matter what their repayment would be. And also note that unpaid interest on subsidized loans is waived for the first 3 years, and half of all unpaid interest is waived on all loans. So that's actually a pretty advantageous piece about this repayee program. The thing that really makes this the most difficult of the programs, or one of the more difficult of the programs for individuals to stomach, is that both you and your spouse's income have to be included in the calculation of discretionary income. So let's give an example of just how impactful that can be. So let's go to our original example where we are using $100,000 as the gross income. Well, let's say that couple was a couple that actually had one individual, and let's say this is the individual that owns all the student loans, makes $60,000, and the other individual makes $40,000. So let's take a look at if they were able to take advantage of married filing separately and use either the IBR or the payee program. So under this, you would do married filing separate. So we have a $60,000 in gross income, and let's just split the retirement contributions 50-50, so 10,000 each. So that would mean the individual makes $60,000 less the pre-tax retirement contributions. So now their AGI is $50,000. Now you take the federal poverty line deduction. And what's great about that is that you do still include your spouse, even though you're not including their income anymore. So you do have that same 12,000 plus 4,000 plus 4,000, 4,000 for the spouse, 4,000 for the child, times 1.5, so $30,000. So now you have 50,000 minus 30,000, $20,000 in discretionary income. And if you're in the old IBR program, that means you're multiplying that number by 15%. So you're only paying $3,000 annually. Or if you're in the payee or new IBR program, you're only paying $2,000 annually, or about $166 per month. And I use the $60,000 because, let's say, especially if you're a resident, residents, this is a pretty standard amount that a resident would make. And it is pretty impactful, especially if you're somebody who has 100, 200, 300, $500,000 plus in loans. The standard payment amount can be considerable, to the point that it's really not feasible for somebody to make repayments when they're in residency or fellowship. And using a number like $166, even if you're married to somebody who's making a decent income, makes the ability to pay your loans through this period a lot easier to stomach. So that's the last repayment plan that I wanted to bring up. So I just now want to go over a little on if the income-based, if an IDR plan is right for you. So I'm sure, as you can tell, there are a lot of variables. It can get pretty complex. You need to think about how am I filing my taxes? Am I contributing to a retirement plan? Am I married? Am I going to be married? How many kids do I have? Are we going to have kids? So these are all things that take some planning and definitely takes some thinking in terms of how do we choose the right IDR plan and figure out our own repayment puzzle. In terms of where to start looking, start by going to studentaid.gov, and here you should be able to see all your loans. And you want to check and make sure they are federal. Are they direct? So make sure if they are FFEL loans, again, you may need to consolidate them to get into certain programs. When are the loans from? Do you have loans from before 10/1/2007? Probably going to have to be in that old IBR plan. If so, do you have loans after 2011 or after 2014? Again, this is important for payee versus new IBR, et cetera. Another really important thing to think about is, can you make loan payments without going into the IDR program? So one thing I want to note about the IDR program, especially without going through the next thing I'm going to go through, is if you're doing an IDR program just the standard way, you're going to have to be making payments over 20 to 25 years. And then, as I mentioned in part one, when those loans are repaid, it is taxable to you in that year. So if you have loans that are several $100,000, and let's say they're negatively amortizing, which means they're growing over time, you could be strapped with a very, very large tax bill that comes when these loans are forgiven, again, after 20 to 25 years. Furthermore, you are going to be paying in that entire 20 to 25 years. So most times it's not super advantageous to actually use these programs all the way out over 20 to 25 years. What these can be very helpful for is if you do need breathing room until your income grows, this can be a very, very effective way to pay your loans and not have to go into forbearance or default. And then the other thing that you really do want to look at is, am I working for a 501c3, a nonprofit, or a government entity? Because that's really a game changer, and where these IDR programs can be massively, massively impactful. So let's dive into that piece. the public student loan forgiveness piece. So it's public service loan forgiveness. I usually know it as PSLF. That's how we'll be referring to it the rest of the time here. So the PSLF program, this is a program that offers federal loan repayment in less time than an IDR, and the amount that's forgiven is not taxable. So again, very, very impactful because you don't have that big tax bomb going off at the end. Furthermore, when I say it's less time, it's significantly less time to get your loans repaid than the standard IDR program. Loans are repaid after 120 qualified monthly payments. So that comes out to 10 years. I will note that that does not have to be continuous. You can do this for 2 years, take some time off, do another 3 years. So it does not need to be continuous, but you do need those 120 qualified monthly payments. And to qualify for this program, you have to, number one, be in an IBR program and making the payments on time in that IDR program. Can be any of the IDR programs that I went over. And you have to be working for either a government entity or a 501(c). Also, you have to have federal direct loans only. So again, if you have FFEL loans, you're going to need to make sure that you're consolidating those into a direct plan. And the other thing is that you have to be, you do have to be full-time status. And that just means over 30 hours, working 30 hours a week for either a 501(c) or a government entity. And I would also note that you can work for multiple. So you can work for, let's say, multiple nonprofits as long as you're getting over that 30 hours per week over a month. And then you will get that one of your 120 qualified monthly payments. Another thing to note in terms of what is a 501(c), how do I make sure that I'm working for a qualified nonprofit? One thing to note is that there's a lot of different types of organizations that can get preferable tax status from the federal government. So you can have things like fraternal organizations and so forth, which aren't really nonprofits. So you want to make sure that you are working for a nonprofit, a 501(c)(3). And then furthermore, even not all 501(c)(3)s actually qualify for this program. Some things to note is if you're working for something that contracts directly with the government, is a partisan political organization, is a religious organization, these aren't going to actually count towards the 501(c) status that you need. So how you really check to make sure that your employer does qualify for this program is you just have to fill out the paperwork. So there is paperwork that you fill out at the beginning of each year that basically says, I'm working for this company. Your company signs it. And then the people that administer the PSLF system will go in and check and make sure that it is a qualifying organization. And if it is, you will be notified, and then you'll be in the program. Really important to note on the paperwork piece is that each year, really, really important to get your qualifying PSLF piece in. So each year you do want to recertify and say, this company that I'm working for is a qualified entity, whether it's a government or a 501(c). And then you also want to make sure, of course, your IDR paperwork is on time and done correctly, because if either of these are messed up, it can really derail everything. There has been some negative press around the PSLF and just not a lot of people actually getting the loan forgiveness through this program. A lot of that really was due to paperwork snafus, and that's why there really are individuals that are able to take advantage of this program and are actively getting their loans forgiven through this program. But you just really have to be on top of the paperwork and really make sure that you are organized. So with that, I just want to talk about some of the key takeaways from our discussion today. First of all, tackling even extreme debt amounts is doable. under IDR and especially the PSLF program. Because of this, I really do recommend starting on focusing with private debt first. And also note that not all IDR programs are the same. So you're really going to want to find an IDR program that's right for you. And note also, I always like to mention this, and really anything that you're dealing with as it relates to loans, is that the loan servicers that you're working with, whether it's Navient, Great Lakes, whatever, these individuals are not financial advisors. They're not liable for the information that they're giving you. So be sure that you're doing your research, preferably working with a financial advisor that really does understand this. But just relying that Navient or Great Lakes or whatever it is going to get you into the absolute correct IDR program given your personal situation. Again, are you married? What are you putting in your retirement fund? How are you filing your taxes? I would not rely on the loan servicers for that level of detail. Another, of course, key takeaway is that PSLF program. It is just so beneficial because, again, you're not hit with that big tax liability, and it's only 10 years. Another thing to note that's really great, especially for doctors, is remember that hospitals are going to qualify for the PSLF program. So let's take somebody like my wife, who's a plastic surgeon. She had a 6-year residency at a hospital, and then she did a 1-year fellowship at a hospital. And now she only has 3 years of working as an attending. And if she chooses to work in a hospital versus private practice, she will be able to take advantage of that PSLF program and get her loans forgiven. So especially for doctors and doctors that may be in specialties where they have quite a bit of training, this can be really, really impactful. Furthermore, if you're, let's say, a PA or a nurse where you know you do want to work in a hospital setting, again, versus private practice, I would really, really consider using the PSLF program. And last thing, just to note, I know I hit home pretty hard on this earlier, but working with a qualified professional is very, very important. This is really, really more complex than I ever would have thought before I really learned this. And there's just so many ways, honestly, that individuals can go wrong with this. And there is just so much paperwork involved. And again, you're bringing taxes into it and things like that. So working with a qualified professional that understands not just loans, but also taxes, investment vehicles, because it really all comes together to take advantage of these programs correctly. So I really do, especially for individuals that are trying to take advantage of these programs and have very high debt levels, working with a professional can be very, very impactful. What we're going to do next time in part 3 is show why this is so impactful. We're going to take 3 different case studies and really dig in. And when you see the numbers of just the amount of loans that can be forgiven and what the payment is over a 10-year period, I think it'll become even more clear why this is so important and just how great these programs can be if taken advantage of correctly. But with that cliffhanger, I will stop talking on this presentation, and I will just leave you with saying thank you for tuning in this entire time. I know this can be a little dry, but again, it's very complex and I think can be very, very impactful. I just, again, really encourage you to listen to part 3 to see how all of this works in action. And I also encourage anyone that hasn't to check out other planning on call material on the Atlas website. And please don't hesitate to reach out to me, Tim Hamilton, your on-call financial planner, with any questions that you have. Thanks a lot.